Hello and welcome to Pensions in 10 with me, David Brooks, and my colleague Simon Kew. This week we take a look at the DB surplus conversation again, but we also look at the PPF levy. We talk about Bank of England repo, Simon will tell you, and we talk about Martin Lewis on the TV talking about pensions.
Well, Dave, as we mentioned last week, there were moves afoot to look at releasing surpluses or access to surpluses in pension schemes, and as predicted, wasn't much of a prediction. Rachel Reeves, the Chancellor, did say on Wednesday last week that they were looking at plans to allow trustees to release surpluses to their sponsoring employers to allow that to be invested in productive finance and indeed into the businesses. So not a shock, really. So shall we leave that there and focus on other interesting things that the government has mentioned? Something around the PPF levy, Dave.
Yeah, so the PPF have been thinking about what they're going to charge for the 25-26 levy year, and they had delayed it from announcing it last year because there's this weird wrinkle in the legislation that means basically that the levy can't increase by more than 25% a year. I think it's 25% a year. And while the PPF might want to charge no levy due to the funding position of schemes and their rude health, if they went to zero, they could never increase it again. So they've held off going to zero. However, there have been movements, and it would seem that there is more, higher chance that the government will correct that legislative issue and allow the levy to go up again should things go against the PPF's funding. And so the PPF have said they're going to reduce the levy from 100 million to 45 million for this forthcoming levy year. So that's really good news. We're nearly there. So I think if the legislation comes through, then I think the PPF have said they would review that 45 million and perhaps go even lower. But the 45 million is there as sort of a prudent amount to still collect from employers, just to be on the safe side, should it need to go up again in the future. So that's really good news, and it's nice. I mean, there's been a lot of lobbying going on from the likes of ourselves and the SPP and others. So that's really good news that the government are listening to sort of sort out these kind of things. And may I continue? There is something else.
You may, because I know you're itching to tell us about something else, Dave.
Yes, you're itching to talk about lots of things. So just on the sort of the subject of the PPF a little. So we know that they have a surplus of around 12 to 13 billion, depending on who you ask and when you look. And there's been lots of discussions around perhaps it changing the way that the compensation is paid. So perhaps getting rid of the 10% haircut that some members have when they go into the PPF, or looking at the pre-97 increases, or looking at the way that GMP benefits are equalised in the PPF. And so there's lots of discussions going on, but there would also seem to be some sort of parallel discussions going on between DWP and TPR to discover more about how pre-97 benefits are paid across DB pension scheme sort of universe. So some members will get discretionary increases, many members will get nothing in respect to service before 97, some members might get something. So it's a bit of a lottery out there. So I think there's definitely some movement afoot into perhaps what could be done to assist members that are affected by having a frozen pension. And we know Working Pensions Committee are looking at pension of poverty, and that could be something that needs to be looked at, and perhaps we are going to see something come through. And whether that's linked to surpluses, so where a scheme has a surplus, maybe people with pre-97 benefits that aren't increased regularly or at all might get first bite of that cherry to provide something for them. So I feel like there's a couple of interwoven areas of sort of policy and the way that the pension system currently works and the way it might change in the future. And part of that DB surplus, there are discussions about whether the PPF compensation could even go higher to assist in that sort of underwriting schemes that are running on to make that more enticing for trustees as well. So I think we're going to hear a lot of these kind of ideas buzzing around. Now, I don't know where they will all end up, but yeah, there's lots of interesting thoughts around. Okay, Simon, so the Bank of England has been thinking about LDI and how pension schemes can react to any issues they may have with their LDI positions. Can you tell us a little bit more about
that? Yes, a little is exactly what I'm going to tell you about that, Dave, because I haven't delved into the details in immense scrutiny at this stage. I'm going to make sure my teeth are in before I sort of tackle this. The Bank of England is now accepting applications for the Contingent Non-Bank Financial Institution Repo Facility, which is snappily abbreviated to CNRF. And that facility will only be active during, quote, episodes of severe gilt market dysfunction. So that's what the Bank of England have said. In short, I think insurance companies, pension schemes, and LDI funds can go to the Bank of England if something is hitting the fan and say, here are my gilts, please give me cash. And the Bank of England has final say on whether they will transact, and you must go to them with at least 2 billion in gilts to qualify for the facility. So small schemes, you're out, I'm afraid. But of course, the fund managers and others will obviously be able to partake. And to partake in CNRF, they will be charged £8,000 a year to cover the bank's operating costs, which, given what happened with that first LDI crisis, seems like small change, really. But one to watch, certainly.
Yeah, and it builds on the Bank of England's work from last year as well. They did a report, didn't they, into sort of the governance and what the regulator had done to help put a bit more resilience into that LDI market. And they were, broadly speaking, fairly positive, I think, about that. And the regulator was pretty chuffed. There might need to be, I think the regulator said they need to do more on some of their data gathering and things just to make sure they're fully across what schemes are doing.
Dave, in an unusual move this week, we saw a primetime television programme, and not EastEnders, tackling the subject of pensions. What was it?
It was Martin Lewis and his live money shows on ITV, and he had an hour looking at, and it was interesting this time, he was looking at private pensions, so how tax relief works on the way in, how you can take your money out in a tax efficient way. So he spent a little while, and there's a video on Twitter as well, or X, talking about how you can take tax-free cash and not take the income, and you can manage your income tax and these kind of things. He also talks about consolidation and a few other sort of private pension areas. So, and some of the good news, I think, well, it's all well and good, and I think that's great. That sort of stuff's out there. The stats came in quite soon after for the viewership, and 2.2 million people watched it live. That's 19% of the available audience. So that's amazing. It was the most watched show at that time slot. So I think it says a lot that people are interested in pensions and understanding how they work. And I want to see more of it, to be honest. I'd like to see a pensions TV series doing something every week at some point of the year for like 6 weeks or 8 weeks or something. They can go through stuff in a bit more detail, because if you look on X as well, I'm still using it. And you can see lots of questions from individuals that are clearly confused about how pensions work. And there's also that sort of subtext that pensions are a scam, or pensions, they won't work for you, and properties are better, and all this sort of stuff. And while there's good arguments that pensions aren't for everybody, but I just feel like, again, this is proof. I think this is kind of proof of concept that if you put something on about pensions, people will watch it. And if you're a trustee watching this, then do be aware that your members might watch this. So it's probably worth you watching it too, just to make sure you're abreast of the sort of questions they might have on the back of it and what they're being told, and how pensions work. Because sometimes people get confused as well. So there are areas he's talking about DC or DB, and if people can get confused between the two, sympathy for them for that. But yeah, I think it's great to see it, and I like to see more.
Absolutely. And if any TV producers are watching, Dave and I are available at very reasonable rates.
Yes, like a taxi and a few beers. I think that's my fee.
Is that your rider, Dave?
That's my rider. Taxi, just to get me home safely, and a couple of beers, and I'll talk about pensions for ages.
He really will, listeners. Dear viewer and listener, that brings us to the end of another Pensions in 10, which has been rather fun to record this week, actually. Thank you so much for joining us. We hope you enjoy listening to us via your favourite podcast provider, fruit-based or otherwise, watching us on YouTube or through the links on LinkedIn. Do, as always, get in touch with your thoughts, and we'll see you next week. Take care.